Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. And today's topic is the capital gain inclusion rate. I've already talked about it multiple times over the last month. I've done probably five different presentations to 5 different groups of people, all talking about the capital gain inclusion rate change raised by the federal budget 2024. And the only challenge is that during every single one of these presentations, I would share some information, share some insight based on the budget announcement, but there was no draft legislation. Fortunately, as of June 10th, Monday, the federal government finally came out with the draft legislation clarifying their position and how they are going to apply the capital gain inclusion rate change going forward. So I thought it would be great to use this video to share with you all the insights that I got from reading that legislation. But before I get started, if you find our information useful, make sure that you give us a thumbs up. If you have questions, make sure you leave it in the comments below. And for those of you who want to stay at the top of the latest tax tips, make sure that you hit the subscribe button below so that you can be notified the moment that we release the new video. Now with that, let's get started. Just to give you guys a little bit of background information, in our earlier federal budget 2024 announcement, our government came out and said, if you're earning capital gain in excess of $250,000, you must be the top 1% earner. You must be those ultra rich people that needs to be taxed more and paying your fair share of tax. And I was so angry about this whole situation because my mom's property is not one of those property. My mom's definitely not one of the top income earner. Having said all that, the federal budget 2024 is proposing to increase that 50% inclusion rate to 2/3. So what it means is that using the same $100,000 as an example, 2/3 of that $100,000 is being added to your income. So in our example, 100,000 times 2/3, which is equivalent to $66,667. Whereas before the change, only $50,000 is being added to income. After the change, it is $66,667 being added to your income. And then you pay tax on that $66,667. So as you can see, there is an increase in that inclusion rate. And it affects a lot of people, especially those people who own properties, for many, many years and just choose not to sell these properties. Affect many landlords who are also my clients, affect myself, who's a real estate investor, also affect people who invest in the stock market with a big portfolio and with a huge accrued gain. Now, when the federal budget came out, the draft legislation wasn't really provided. There were only 2-3 paragraphs describing this change in the budget 2024. And it was really extremely hard for professionals like us to advise our clients how to realize and capitalize on this capital gain change deadline and essentially recognize some of the capital gain before June 25th, 2024. This draft legislation came out on June 10th, is able to answer a majority of the questions. One of which is the capital loss treatment. Some taxpayers are asking like, what if I realize the capital loss after the rule change? What's gonna happen? What if I recognize the capital gain after the rule change? Or what if I have capital loss carry forward? So I'm going to use a really simple to understand example to illustrate how this capital loss treatment is being affected if you have any capital loss carry forward. So let's use a real example to explain. It's actually on the CRA's website as well. Now let's say someone incur a capital loss, realize a capital loss before June 25th, 2024. Now you may wonder how this is being taxed. Well, under normal circumstances, before June 25th, this $300,000 would have like a capital loss inclusion rate of the same 50%. The net capital loss for tax purpose to offset against other taxable capital gain would be $150,000. So before I go deeper, for those of you who don't know capital loss, if you incur capital loss on sale of a property or on sale of stocks, and the capital loss would be eligible to be offset against any other capital gain that you're reporting. So the net amount would be taxable. So if you are realizing a capital loss and you're not able to offset against any capital gain incurred during the particular taxation year, you can carry that capital loss forward to future years, and it could be applied to capital gain that you realize in future years. The rule around capital loss is a topic of another day. Essentially, if you realize the capital loss and cannot use it to offset against capital gain incurred in the current year, you would then be able to carry back for 3 years and carry forward indefinitely until you incur the capital gain and offset against the capital gain. Now, with that in mind, essentially, this $300,000 capital loss that you realize before June 25th would have the inclusion rate of 50%. Therefore, the net capital loss for tax purpose would be $150,000, 50% of your $300,000. Now, capital gain, let's say in 2025, you realize a capital gain of about $400,000. Now, under the current rule, the first $250,000, assume that you own the underlying asset in your personal name. The first $250,000 of capital gain, the first $250,000 of the $400,000 that you realize, is having an inclusion rate of 50%. So essentially, the taxable capital gain for that first $250,000 would be $125,000. Now, anything above and beyond that $250,000 is being taxed, is having that new inclusion rate, which is at 2/3, and which is equivalent to 67%. So you take $400,000 minus the first $250,000, resulting in $150,000 additional capital gain that would be taxed at 2/3 inclusion rate. And when you multiply the two, the final amount would be $100,000. Essentially, the amount that's being taxable is $100,000 plus $125,000 A plus B, total of $225,000. So the question asked by a lot of investors is that, hey, how is my $150,000 that I recognize before June 25th going to be able to be offset against my future capital gain that I realize that has a portion of it having 50% inclusion rate, whereas the other portion having that 67% inclusion rate. Now, CRA's website provided a huge example that is really difficult to understand. The way that I understand it and the way that I apply this principle is really going back to the basic, going back to the gross amount. So what's the gross amount? The gross amount is the first amount, the capital loss, the actual amount of loss that you incur before June 25th, and the capital gain realized, the actual gross amount. And these two numbers, what I do is let me just insert. Let me show you guys with the proper number. So this amount is the loss, $300,000. And this amount is the gross gain. They are gross, on a gross basis before any inclusion rate adjustment. The taxpayer is eligible to offset the capital loss against the capital gain. So in our example, I take the $400,000, subtract the $300,000 loss, and I would result in $100,000 of gain. Now, $100,000 is less than that first $250,000 inclusion rate, and therefore the inclusion rate being applied to that $100,000 gain would be 50%. And if you take that, this would be 100,000 multiplied by 50%, and this would become your new taxable capital gain. So the government is going to give you a lot of adjustment factor, and sometimes you don't even understand it. But to me, the easiest way to calculate it and calculate the offset amount would be the amounts that using the gross amount. Easiest way to calculate. So taxable capital gain for this taxpayer would be $50,000. And the current legislation does clarify how to calculate and how to offset the capital gain and the capital loss when there is different inclusion rate being involved. So in a nutshell, the capital loss that you incur carry forward will be adjusted, and then the capital gain that you realize after June 25th will all be adjusted based on the relevant factor that's on CRA's website. But if you don't want to use those relevant factor and difficult calculation, you can just use my silly way of grossing it back up to where it is, and then what the original capital gain or capital loss amount is, and then do your math calculation, it would make it a lot simpler. You're not being disadvantaged for having capital gain realized after the fact, after June 25th or before June 25th. That's the message. Now, the second thing that the legislation clarifies is the vendor take-back mortgage. So just to backtrack a little bit, I talk about vendor take-back mortgage in a different video. But for those of you who are real estate investors, particularly land developers or landowners, when you sell a property, you may offer something called a vendor take-back mortgage. What it does is that it allows you to sell your property, but at the same time, you're financing the buyer to purchase your property. So let's say you sell a property for $1 million, but you don't collect $1 million at the time of closing. You collect maybe $500,000. The rest of the $500,000 would become payable over an agreed amount of time and term. So that's called vendor take-back mortgage. Now, we talked about how this works in the past in the different videos, so please visit the other video to get a better understanding. But particularly, the question is, hey, if you are entering this type of contract, vendor take-back mortgage, and you're not getting the money until the next few years, as a taxpayer, you're eligible to defer a portion of your capital gain and spread it out to a maximum of 5 years to report. Year 0, the day that you sell the property, you have to report a certain amount. Year 1, you report another amount. Year 2, you report something. Year 3, you report something as well. Year 4, the last year, you report the remaining gain. And this is calculated based on a formula provided by CLA. Now, the question then becomes, hey, what if I have a contract and I'm doing vendor take-back mortgage? I sold my property at the beginning of the year, 2024. And I'm eligible to essentially defer my capital gain to be reported over the next few years. And should I take it or not? Because now the capital gain inclusion rate is increased. So what's going to happen to all these deferral? Well, what's going to happen is that CLA in this version of the draft legislation clarify their position. Essentially, the capital gain that you would be using for capital gain inclusion rate that you would be applying to your vendor take-back mortgage, to your capital gain deferral, would be based on the inclusion rate at the time the recognition happens. So let's say you are eligible to defer $500,000 of capital gain over the next 5 years. So essentially, year 1, you recognize 100, year 2, you recognize another $100,000. The $100,000 that you report in year 5 would be, CLA is going to apply the capital gain inclusion rate that's effective at year 5. So it's not going to be backtracked back at the time when the transaction happened. So it may or may not be advantageous to you depending on how your ownership structure works. If you own the property in a corporation or in a trust, the capital gain inclusion rate starting June 25th, 2024 and onwards, it's going to be 2/3. So for those of you who have a deal, who had some capital gain deferral happening, you may want to consider and check with your accountant and recognize the capital gain in the current year. Now, for those of you who own the properties in your personal name, it's a lot of motivation for you to spread out the capital gain over the next 5 years, because every single year you're going to get the first $250,000 capital gain, 50% inclusion rate. So depending on your particular situation, everyone's situation is different, but the current draft legislation essentially said that the amount of inclusion rate that's used to calculate your taxes would be based on the inclusion rate that's effective at the time when you recognize the capital gain and add it to income. So depending on your situation, it may be beneficial to recognize all the capital gain right now before June 25th, 2024. And for some of you, it may be way more beneficial to spread it out over the next 3, 4, or 5 years. And for those of you who are looking into doing vendor take-back mortgage, again, depending on the ownership structure, it may or may not be beneficial. I have a client who's working with a builder right now, and she may offer this vendor take-back mortgage as a matter of fact to get the deal going. The builder is hoping to get some vendor take-back mortgage from her, and she owns the properties in her own personal name. So for her to enter into the contract, likely the sale date would be happening after June 25th, and she would be able to spread out all her gain or a portion of her gain based on the terms and conditions of the mortgage over the next 5 years. And it would be a lot more beneficial for her because, for one, she would be able to apply her lower marginal tax rate because she owned the properties in her personal name. Number two, because she would be able to apply that $250,000 50% inclusion rate, preferential inclusion rate, or to at least to every single year there is that $250,000 available for her to apply. We clarified these two positions, nothing really changed. We kind of know about that. Now, here is what we hope to change but didn't get changed. Number one is the accounting community was hoping that the trust and also the corporation would also get this $250,000 preferential inclusion rate. So for the individual taxpayer who realized capital gain under $250,000, the first $250,000 is having that 50% inclusion rate. Anything above and beyond would have 2/3 inclusion rate. But for corporation and trust, there is no $250,000 de minimis inclusion rate, no preferential treatment. So if you own properties in your corporation or if you own properties in trust, in a family trust, these rules did not change, and so please be prepared that you would be paying more taxes because you chose to own the properties inside the corporation. I know it sucks. Blame the government. Well, what if you own a property that has $100,000 accrued gain as an individual? If that's the case for you, potentially you could just sell 25% of your asset in year one, 25% of your property in year two, 25% of your property in year three, and then another 25% of your property in year four. So every single year you realize $250,000 gain, and that $250,000 gain would always be having that 50% inclusion rate. So to you, you're averaging it out to maximize the use of $250,000 50% inclusion rate. Now, CRA's legislation came out and clarified their position, specifically calling that capital gain averaging is not allowed. So don't even think about using that as your strategy, because in my head, that is at least in my head, I'm thinking all about that this is what I'm gonna do with my client, but I'm sorry. I feel sorry for the Canadian out there as well. If you want to do some tax planning around this $250,000, it's not available for you. And other clarification that came out from this whole announcement of this the current version of the draft legislation, is that tax election is not allowed. Let me explain what tax election means. Now, the tax election is in the context of choosing to realize a portion of the capital gain without actually selling it to the third party. Now, let me use an example to explain. Let's say I own this property for $250,000. I could sell it at today's fair market value at $850,000. So I have a capital gain of $600,000. So some taxpayers out there were saying, hey, can I have an election to choose to recognize this $600,000 capital gain immediately? And I will pay the tax, but I'm not transferring it to anybody, but I'm just electing to realize the capital gain, and I'll pay the tax, so then the government still gets your money. We don't have to do any transfer, incur any extra costs. The problem is that the government came out, the legislation came out and said that is not allowed. There is not going to be any tax election to allow you to recognize the capital gain on a paper basis. You actually do need to transfer the economic substance to a different entity or different person and actually conduct the sale of the property to have this $600,000 capital gain being realized. And then you have to pay the tax. Now, if you're talking in the context of rental properties, this also means that you would have to trigger the land transfer tax. You will also need to get the consent from your bank to approve the transfer as well. And you also would need to pay the lawyer additional costs of doing the transfer for you as well. So this is a very unproductive way of telling the world that, hey, I don't care. If you want to recognize this gain and take advantage of it, you actually need to pay more taxes because now land transfer tax has to be paid and trigger for the most part. Another idea that's floating around as well, and actually my father-in-law messaged me to ask me this particular question after the budget was announced, was that, hey, would it be possible that the government would allow us to recognize all the gain up until June 25th with 50% inclusion rate, and then anything above and beyond that day, it would be recognized with 2/3 inclusion rate. So this is all coming from the time when there was no capital gain calculation at all. There's no capital gain tax at all. And at that time, when capital gain taxation was first introduced to Canada, what happened is that the government allowed a valuation being done on the properties, and for any accrued gain up until the point that they start taxing your capital gain, it would be tax exempt. Because before that day, it was long time ago, before my time, there was no capital gain tax. So you don't have to pay tax up until that point. You don't have to actually realize a sale to take advantage of that valuation date. Only anything above and beyond that valuation would be subject to tax and capital gain tax. Now, draft legislation came out and said, well, unfortunately, that's not available. That's not an option. So if you're counting on the fact of doing a valuation as of June 24th, 2024, and say that, hey, this portion of capital gain up until June 24th would be subject to 50% inclusion rate, anything above and beyond would be subject to 2/3, which to me sounded a lot more fair compared to just using 2/3 inclusion rate, slash it all to apply to everybody. This current version of the draft legislation is saying that it is not available at all. So what it also comes back down to is you are still going, if for those of you who have the money to pay for the tax, who have the money to pay for the land transfer tax, income tax, as well as the cost of transfer, the lawyer fees, you will need to actually sell to an entity or sell to a person, execute the actual proper sale of the property to realize the capital gain and pay for the tax. There is no choice, no election, no time-based averaging, no time-based distinction. Now, another thing that they came out to clarify, which is called splitting the income, splitting the threshold with corporation. They clarify that you are not allowed to split as an individual. You're entitled to that $250,000 50% inclusion rate. You're not allowed to split that income, or you're not allowed to split that threshold $250,000 with the corporation that you own personally. Now, what does that mean? I don't know. I don't really know what it really means, but my guess is that from a real estate investor perspective, if you form some sort of a joint venture with your corporation, you're not allowed to have a portion of your capital gain being sheltered with the $250,000 threshold. That's my guess. But essentially, they're not allowing you to split that threshold and take advantage of the $250,000 50% inclusion rate preferential treatment. So if you ask me, are there any good news coming out from this draft legislation? Absolutely nothing. It's even more disappointing than before because they continue on their path of discouraging tax integration. Tax integration is our Income Tax Act is designed in a way that the tax should not be a determining factor on how you own your particular investment. And now they're making it a determining factor, one of the deciding factor, because corporation is being taxed differently compared to individual taxation. So sucks to be real estate investors these days, unfortunately, but that's the update. Well, if you find our video useful, please give us a thumbs up. If you want to stay on top of the latest tax tips, make sure you hit the subscribe button below. Until next time, thanks for watching.